Mr. President.
Senator from Pennsylvania is recognized.
Thank you, Mr. President. I rise today to discuss the Senate's upcoming trade agenda and its impact on Pennsylvania workers and Pennsylvania jobs. Like so many of our states, Pennsylvania has always played a critically important role in America's manufacturing and commercial heritage. The coal and waterways of our state help make the Commonwealth legendary for steelmaking and help turn the United States into an industrial powerhouse. During its heyday, 60% of the domestic steel production in the United States came from Pennsylvania. During World War II, almost 1/3 of the nation's steel came from Pennsylvania, which was a full 20% of global production at the time. The then Pennsylvania Governor, Arthur James, put it this way: Pennsylvania was truly the arsenal of democracy and the arsenal of America. Given its dominance in the steel industry, it's no surprise that the Commonwealth was 6th in the nation in total war production during the Second World War, leading in shipbuilding and munitions production. More money was spent to expand production capacity in Pennsylvania than in any other state during the war. And we know at the time that it didn't stop there. It didn't stop at the end of the war. After the war was over, these manufacturing facilities were used to make American products and fuel the growth of a thriving middle class. Today, so many of these plants have gone away, due in part to our failed trade policies. Over the last 30 years, we've seen trade deficits soar, currency manipulation go unchecked, lavish subsidies by foreign governments go ignored, and exploitation of workers in other countries overlooked. That's why I'm very concerned that today the Finance Committee is moving forward with the pending agreements with South Korea, Colombia, and Panama. For the last several weeks, the presiding officer, Senator Brown, and I have persistently asked the tough, critical questions about the impact of these agreements before they're considered. A review of the impact of past trade agreements offers very little comfort. In 1994, Congress passed the North American Free Trade Agreement, creating the world's largest free trade zone. We know it as NAFTA, and since NAFTA's passage, U.S. trade policies have steadily chipped away at Pennsylvania's manufacturing base, a critical sector for our state and so many others. According to a recent study, and the chart on my left depicts it, by the Pennsylvania Industrial Resource Centers from 1997 to 2010, just 13 years, manufacturing went from 16.4% of our state's gross state product to 12.1%, a remarkable drop in just 13 years. And what does that mean for the total number of jobs? In total, Pennsylvania lost nearly 300,000 manufacturing jobs. And you can see it from the chart. Starting in 1997, the drop to 12.1 in just those 13 years. 300,000 jobs in 13 years. Despite these alarming numbers and statistics, advocates for the trade deals, including the pending agreement with South Korea, promise significant economic benefits, from exploding export potential to direct job creation. Proponents argue a significant net positive from these agreements every time they're considered. In reality, instead of creating opportunities for Pennsylvania, our trade policies did little more than offshore good-paying jobs while giving our trading partners unlimited access to our markets. So we must take the time now to ask the tough questions. Specifically, as a senator from Pennsylvania, I must ask 3 basic questions about any trade deal. Number 1, will the agreement protect current Pennsylvania jobs and create new jobs in Pennsylvania and across America? Number 2, will the agreement help create a level playing field for American businesses and workers? And third, does the agreement provide new opportunities for American manufacturers to export? Today, I'll focus on the South Korea trade agreement in the context of each question. First, will the agreement protect and create jobs in Pennsylvania and across the nation? In these uncertain times, job creation must be our top priority. In Pennsylvania, the manufacturing sector is critical. Manufacturing remains the Commonwealth's largest source of good-paying jobs, with chemical, primary metal products, fabricated metal products, food products, and machinery making up the top 5 manufacturing sectors supporting Pennsylvania families. These benefits extend beyond individual manufacturing businesses in our state. In fact, the economic benefits of a strong manufacturing sector experienced throughout Pennsylvania's economy. According to research commissioned by the Pennsylvania Industrial Resource Centers, every $1 increase in demand for products manufactured in our state leads to an increase in gross value of $2.52 across all industries. So $1 in activity can lead to $2.52 in value. The manufacturing jobs that are created support middle-income families, and the creation of those jobs and the support they provided to those families in 2008 meant the following. The average annual compensation of a worker in the manufacturing sector was over $65,000. The average pay for the rest of the workforce was $10,000 less. Each good-paying job in this country allows for more money to flow back into the economy. Given the importance of manufacturing jobs in Pennsylvania, we must ask ourselves, will the Korea trade agreement create jobs, especially in the manufacturing sector? I believe it will not create a substantial number of new jobs in this critical sector. Looking back over the last 20 years, trade-related job expansion has been an unfulfilled promise for Pennsylvania and the nation. We need look no further than NAFTA. In 1993, when the agreement was signed, NAFTA promised to deliver hundreds of thousands of jobs across the United States. Leading economists at the time projected NAFTA would bring 170,000 new jobs in the near term alone. These gains were not realized. Instead, since NAFTA was signed into law through 2002, 525,094 workers were certified as displaced under NAFTA, according to the Department of Labor. And I'm sure that number's grown since that 2002 data point. Furthermore, when NAFTA was negotiated, leaders suggested that American exports would expand greatly to meet the newfound demands of the open Mexican market with all of its new customers. The opposite has occurred. In 1993, the United States had a small trade surplus. We had a surplus with Mexico. According to the official Census Bureau statistics, by 2010, 17 years later, we were running a trade deficit with Mexico of $66.4 billion. So a surplus in trade with Mexico became a huge deficit. Trade with Canada also saw a widening trade deficit from $10 billion in 1993 to $28 billion in 2010. So there, a deficit got bigger, whereas in the case of Mexico, it went from surplus to a massive deficit of $66 billion with Mexico. The impact of these policies is plainly seen in employment data. Pennsylvania has seen a dramatic decline in manufacturing employment since NAFTA was implemented, losing a total of over 300,000 jobs, as I said before. With this rosy prediction for NAFTA in mind, a close look at the government's projections for the South Korea agreement should be viewed with great skepticism. While the International Trade Commission predicts our bilateral trade with Korea will improve, the total U.S. trade deficit is predicted to get larger. While the proponents of the agreement argue that U.S. exports to Korea will increase, they are neglecting to tell the whole truth. Companies will simply shift from exporting to creating current customers in other places to Korea, rather than increasing total exports. Second question I ask is, will this agreement help create a level playing field after enactment? I believe that this agreement, the South Korea agreement, will fail to create a level playing field for our workers and our companies. Modern trade agreements do more than cut tariffs. These agreements contain hundreds of provisions that make substantial changes to non-trade policies, and the Korea Agreement is no exception. According to the group Public Citizen, these non-trade provisions limit the authority granted to elected representatives of the American people over product and food safety, financial regulations, healthcare and energy regulations, patent terms, and even how tax dollars can be spent by the government. The agreement allows Korean exporters, I should say, to take investment disputes out of courts and into unaccountable and secretive international tribunals through a process known as investor-to-state dispute system that is similar to NAFTA's. Additionally, the investment chapters were signed prior to the current financial crisis back in 2007. These specific chapters include rules that prohibit either country from imposing firewalls between the sorts of financial services one firm may offer to limit the spread of risk, for example. Important protections put in place after the financial crisis of 2007 and 8 could potentially be challenged under the pending agreement. Even more troubling is the issue of Korea's currency. South Korean currency manipulation remains an unaddressed problem. As we've seen in China, an intentionally weakened currency leads to a fundamentally unbalanced trade relationship and brutal conditions for U.S. companies. In a June 17th report, the Economic Policy Institute calculated that if Asian currencies were strengthened to appropriate market-determined levels, if that were done, U.S. gross domestic product would increase by as much as $285.7 billion, or 1.9%, creating up to 2.25 million U.S. jobs. That's if Asian currencies were strengthened to those appropriate levels. Unfortunately, as with other NAFTA-style free trade agreements, this South Korea agreement is silent on currency. This is unacceptable because South Korea devalued their currency twice, once in 1988, once in 1998. Both interventions devalued their currency by 50% or more. South Korea was one of the first countries cited as a currency manipulator by the Treasury Department in 1988. South Korea continues their long history of manipulating their currency. In fact, the most recent Treasury report to Congress on international economic and exchange rate policies from May 27, 2011, noted that South Korea intervened, quote, heavily, unquote, in its currency market during the financial crisis and has continued uninterrupted since. Treasury urged South Korea to, quote, adopt a greater degree of exchange rate flexibility and less intervention, unquote. Currency policy has played a central role in China's mercantilist trade policies and has cost the United States thousands and thousands of jobs. We should not be cutting tariffs with a country with South Korea's heavy history on currency manipulation without language to deal with protecting us in a competitive environment and in the devaluations that they've undertaken before. Additionally, several groups have raised the possibility that the agreement could be used to weaken U.S. trade laws. The free trade agreement creates a bilateral commission on trade laws. While our trade representative argues that this will not change any existing U.S. trade laws, this avenue could be used by advocates of weaker enforcement in the future. Finally, I turn to the last question. Does the agreement provide new opportunities for Pennsylvania manufacturers to export their goods? Like NAFTA, the benefits of the South Korea deal have been, in my judgment, overstated, while the risks have been largely ignored. Rather than opening a new market for Pennsylvania farmers and manufacturers, I'm concerned that the benefits to the United States are minimal at best. There are specific reasons this deal fails to deliver for Pennsylvania exporters. First, most of the benefits are based on an overly optimistic projection for agriculture. These projections, compiled by supporters of the agreement, assume that a cut in tariffs will immediately equal a growth in market share. We know from past experience that Asian markets, including South Korea, have come up with a host of unjustified non-tariff restrictions to keep United States beef out of their country. These barriers to free trade are likely to limit export potential and are largely unaddressed in the agreement. There are other troubling clauses dealing with the beef industry. The South Korea agreement will allow American beef packagers to use Canadian or Mexican cattle and then export the packaged Mexican and/or Canadian beef as, quote, American, unquote, beef. This policy, while great for beef packagers, undercuts United States ranchers. Given our difficulties in gaining a foothold in these markets, we should rely solely on U.S. cattle, which we know is safe. Second, for one of Pennsylvania's most important sectors, dairy, the competing European Union free trade agreement with South Korea could inhibit our ability to compete in the South Korean market. The text of the European Union agreement specifies that certain types of cheese, including mozzarella, must come from specific regions. As a result, European exporters could challenge U.S. producers selling cheese in South Korea as, quote, mozzarella or, quote, Parmesan, unquote. In this sense, the Europeans have negotiated a better agreement, giving European companies an advantage over American companies. Another problem with the agreement is which goods qualify for, quote, made in South Korea designation, the sticker, so to speak, and are allowed to therefore enter the United States duty-free. Under the rules of the agreement in Annex 6A, 65% of the value of many goods, including automobiles shipped duty-free to the U.S., can come from South Korea and still be considered, quote, made in South Korea. This standard is lower than the European Union agreement. The European agreement has a 55% content standard where content can be foreign and once again places our companies at a comparative disadvantage in international competition, just as the chart depicts. 35% Korea plus 65% China would equal made in Korea. I don't think that's what the American people bargain for when they expect us to get trade policies right. In a sense, this opens a door, really a back door, for products primarily made in places like North Korea or China to enter the United States of America duty-free. That is wrong, it should be changed, and we should not vote for an agreement that has that in it. So let me conclude, Mr. President, with the three questions that I started with. First, will the agreement create a substantial number of new jobs? I'm concerned that it will not. In previous agreements like NAFTA, if there are any indication, the U.S.-Korea agreement will lead to job losses, especially in the critical manufacturing sector. Second, will the agreement help create a level playing field? It will not. The agreement fails to address critical issues like currency manipulation that have already hurt American businesses and cost us jobs. Does the agreement provide new opportunities for American manufacturers to export? Proponents have overstated the benefits. Certain industries and firms are likely to benefit while many others will not. What is clear is that in its failure to address non-tariff barriers to trade, the agreement leaves American firms unprotected and on a playing field that is not level. Instead of moving ahead with a broken model, we need to focus on the bigger picture, formulating a strategy that helps American manufacturers, that leads to job creation and helps middle-income families help us create the jobs of the future. To make real sustained progress, Washington needs to have a plan, a strategy. We must develop and commit ourselves to a national manufacturing strategy that includes job-creating trade policies as well. Recently, I convened a roundtable in Pennsylvania, leaders of several southwestern Pennsylvania companies at the Universal Electric Corporation in their ideas to Washington, D.C. to keep a focus on supporting manufacturing. I heard a number of common themes. First of all, we should develop a national strategy, as I mentioned, for manufacturing. Second, we should make the R&D tax credit permanent. Third, we should crack down, really crack down, on China's currency manipulation and other unfair trade policies so that Pennsylvania companies and our workers have at least a fair shot. Legislation I recently introduced gives us those tools to hold countries accountable for manipulating their currencies. Fourth, extend trade adjustment assistance to help workers who have lost their jobs to overseas unfair foreign competition so they can build new skills and find new employment. Finally, invest in science, technology, engineering, and math, the so-called STEM disciplines, which we know will create many jobs in the future. Manufacturing is the heart and soul of Pennsylvania and our nation's economy. Our future depends on developing policies that help our workers and our businesses compete in the global production of goods. Our workers and our businesses can outcompete anyone in the world, any country in the world. We just need to give them a fair shot. We need to give them a strategy, and these agreements don't do that. Mr. President, I would yield the floor.